Hello, Ed Yardeni here. Some of you folks asked me to give you a close-up of Bailey. This is Bailey. Max decided he didn't want to join, and Chloe usually sleeps all day and interrupts us every now and then. She's the one that's the older of them, but Bailey's a good girl. Okay, Bailey, you do whatever you want now. Okay, so today is April 4th, and as always, there's lots to talk about. Clearly, the market remains relatively volatile. On the other hand, it's done remarkably well in the face of the Fed likely to be moving to bigger rate increases. February, in February and March, we started to see the markets being talked to by the Fed and thinking that instead of a 25 basis point hike at the May meeting, it will be a 50 basis point hike. And maybe that'll continue to be the pace, depending on the data that the Fed looks at, particularly on inflation. And on April 12th, we're going to get a CPI number, and that'll be very important, because if it continues to show that inflation is heating up and doesn't give us much signs of moderation, then the Fed will be under pressure to certainly do 50 basis points at the May meeting, and maybe do another one after that at the following meeting. And yet, notwithstanding all that, the market has had a pretty good rebound here. We had a correction from January 3rd to March 8th, lasted about 65 days or so. And in that correction, we saw the market dropping 13% on a closing basis from January 3rd to March 8th. And since then, well, prior, I guess we had as high as 11% from the low, but now as of Friday, we were up 9%. So that's pretty good, and we're only 5% below the all-time record high. Of course, within that, there's a lot of there's a lot of devil in the details, and in that closer look, we know that energy has been the big outperformer so far this year. But again, since the March 8th low, we've seen a pretty good rebound in information technology, for example, financials. So it's broadened out again. So where are we now? Well, we're looking at the rest of the year and maybe into next year as well. And we continue to try to fine-tune our forecasting model for earnings and for the stock market. And just the past week or so, we decided that given the volatility in the market, it makes more sense to give you a range for the market this year, next year, rather than to try to pretend that we can get a point estimate exactly right for the end of the year. So let's look at the charts and see where they take us. If I can find them. Nice. Let's see. Share. There they are. Okay. Okay. But it just made it go away. Hold on. There they are. Okay. So this is my touch screen here, and I touched something that made it go away. But let's look at these charts. Let me make it a little smaller. If you're having any problems seeing these things or hearing me or anything, just send me a response. One or two of you can say everything's going just fine or okay. That'll give me some confidence here that there's somebody on the other end watching me here. Actually, there's almost 200 of you, so I appreciate your time. And appreciative of your time, I'm going to try to keep this to 15, 20 minutes, and then Q&A. So here we go. So the market's been volatile. We've seen that the market forward PE was remarkably stable around 20 to 23. I don't know if that's called stability, but I would say it was stability, because since the middle of 2020, we've been ranging around, let's say 21 on the forward PE. And that's actually pretty impressive when you consider the fact that along the way, we've seen increasing concerns that the Fed was finally going to move into a tightening mode as a result of inflation. And sure enough, from March of last year till March of this year, we've seen a significant increase in inflation from about 2% to 7.9% on a CPI basis, I should say through February at least. And yet this stayed remarkably stable. And silly me, I thought that maybe this trend could continue in the face of rising interest rates and rising inflation. And the thought process was that there's just so much excess liquidity that still is in the system. There's still M2 is about $3 trillion higher now than where it might have been if we just extrapolate the pandemic uptrend. Well, we started out the year and with the PE taking a big dive here, got down to 18, and now it's back to 20. So clearly a lot of the volatility, and the volatility is always attributable on a short-term basis, obviously to the PE, not to earnings, and we'll see that in a second. Here, by the way, is that correction, 13% correction. It was actually 64 days, and along the way here, you can see the bear market back here. We've kind of kept a record of some of the corrections. Thank you for those who are saying everything's working out. So we've had some corrections, which is 10% or more, and then we've had some mini corrections, which we put in here as well, just so you can stare at this chart and get something out of it, I hope. The question, of course, is where is the valuation multiple going to go over the rest of the year into next year? Before we get there, this is another slice and dice of the S&P 500 relative to the bear market back in 2008 and relative to corrections and mini corrections. And then you can also see where the market is relative to its 50 and 200-day moving average. And I'm not a big fan of using those averages. I like looking at the averages when the market has been well above its 200-day moving average, but I'm not sure what that would have told you. It would have told you to maybe get out because there's going to be a correction. Oh, by the way, I'm not a big fan of calling corrections because I think in order to call a correction, you also have to have confidence that you can tell people when to get in again. And I've seen lots of great forecasts of tops in the market that forgot to tell people to get back in again. So I'd much rather tell you whether it's a bull market or a bear market, and I think it's still a bull market going into the rest of this year and even next year. So here's another slice and dice of the stock price index relative to where it closed the year before. And again, we're about 5% below the record high, which happened to occur on January 3rd. So here we go. Here's our ranges now. We're thinking 4,200 to 5,000 for this year is the range. 4,200, we actually made a low a little bit below that on March 8th, but the idea is that's a pretty good place to kind of stand our ground and find buying opportunities, and going up to 5,000, and we're not that far off from that. A level that would be a record high, obviously, might present an opportunity to cash in some chips, mostly because of uncertainty about how much the Fed will do, how much it'll have to do, and how long inflation stays higher for longer. This is wrong. If you read the text, you'll see that the bottom of the thing should be 4,700. So we're going to correct that shortly. So I'm sorry, 4,800 to 5,700 is our range for next year. There's nothing particularly scientific about it, but we try to put some science into it or some arithmetic into it. In a second, I'll show you. But here's the Blue Angels. Here's the forward earnings, the PE times E. We use forward earnings and the forward valuation multiple. And as you can see, the forward earnings has been on a tear here, the nice V-shaped recovery compared to this more U-shaped recovery in forward earnings. And it keeps making new highs here. So while the market is trying to figure out whether to go up or down or sideways, forward earnings, which is analyst consensus expectations, continue to go up. And those are very reliable with one important exception. As I said before, analysts don't do a very good job of anticipating recessions. That's my job. That's your job. We have to have an opinion. If you don't think there's going to be a recession in the next 12 to 24 months, then the conclusion is that this is actually a pretty good leading indicator for actually what's going to happen to earnings 12 months from now or 52 weeks from now. You can see here that we had a significant sell-off in the stock market because both PE and E took a dive. You can see that we went from this PE down to this PE, and that the forward earnings at the same time took a dive. See the same thing. So bear markets occur when both earnings and the PE go down. Corrections occur when the forward earnings are going up or trending up, or maybe going sideways for a little while before trending higher. But at the same time, you get the corrections in the valuation multiple. So we've certainly had a correction here, a 13% correction. And again, we've got the correction lines there for you, particularly for the actual corrections of 10 to 20%. Just as I started to thinking about maybe 2021, 22 was too high for the market, and that maybe we're going to see something like 16. It held at 18 and bounced back to 20. But now we're using a range of 16 to 19 just to indicate our uncertainty about how the valuation multiple is going to respond to all the excess liquidity versus the Fed tightening. Also, I put this in a different way, that we don't have the Fed put anymore, but we still have the CFO put, because some of this liquidity is sitting on corporate balance sheets. Corporations are generating huge amount of cash flow. And so mergers and acquisitions, buybacks, dividends may be able to offset the fact that we don't have the Fed coming in and making us feel better every time we get a sell-off. This is just a monthly version of the same thing. You can look at it on your own. Okay, so let's do, let's dig into this thinking of where's the market going from here. Just do the arithmetic, as I said. First of all, revenues are shown here, and this is revenues per share multiplied by the S&P 500 divisor. So that Joe Abbott, my colleague, my sidekick, figured out how to calculate total revenues of the S&P 500. And just to give you some perspective, we put business sales of goods. Obviously, the revenues are goods and services for the S&P 500, but this also shows business sales of goods. It can be a very volatile series and tends to correlate better with the red series, the S&P aggregate. And then here's nominal GDP. They are kind of apples and oranges. You don't want to just look at that and say one should add up to another. But the correlations are important. And here's another slice and dice of that, looking at goods, nominal GDP of goods. The reason for that is services just aren't very volatile until of course, the lockdowns. But the reality is, historically, the growth rate of revenues has been correlated with nominal GDP, as you can see here. So here's, I'm really just getting to the point where I just want to say that revenues correlate well with nominal GDP. Nominal GDP reflects inflation, and as does revenues. That's really the point, is that the S&P 500 is a good hedge for inflation, first and foremost, because revenues reflect inflation. So you can see that especially when you take the correlation of aggregate revenues versus nominal GNP and put both of them on a year-over-year percent change basis. It's a much tighter fit and correlation. This is just another slice and dice of that. It's the aggregate revenues, again, year-over-year percent change versus the inflation rate. We didn't really have to think about inflation much because it was just such a low component of nominal sales, but obviously that's changed based on the non-farm business price deflator. So here we got revenues over non-farm business price deflator, just another slice and dice, demonstrating that revenues not only keep up with inflation, but beat inflation. Again, stocks are a good inflation hedge. Well, what is the inflation outlook? It's because of the Ukraine war, we concluded it's going to be higher for longer. Higher for longer means that we now think that we'll see the core rate and the headline rates get into this kind of range, which is 6 to 7%, and that'll happen in the first half of the year. Then the second half of the year, we think it might moderate to 4 to 5%. We had been thinking more like 3 to 4%. Now it seems like more of 4 to 5%, well above the Fed's 2% intended target. What might bring it down? Well, we still think consumer durable goods, which have been the big source of inflationary pressures, will moderate. Why won't it go down to 2%? Well, because rent inflation is going to be a real headache for the next 2 years at least. Home prices are up 33%. Leases are up 12% for new leases on a year-over-year basis. New leases eventually get into the CPI numbers as they become after a year or two of leases being renewed. So that the rent inflation is going to be the biggest inflationary headache for the Fed, I think, and something they're just not thinking about for them to actually think they're going to get inflation down back to 2%. And next year, they might get it down to 3 to 4%, but I think that's kind of the new normal. I kind of doubt that they're going to get it down to 2% without causing a recession. And I really think this Fed does not want to cause a recession. I think they are going to be relatively gradual, relatively data dependent. They're going to want to avoid kind of doing a Volcker 2.0. So let's look at figure 14 here. Here's the revenues per share. And we've raised that number to reflect our feeling that inflation is going to be higher for longer. So these are the numbers we're using now. This is visually, you can see what they're doing. This looks a little crazy, right, relative to this kind of trend. But what's crazy here is the inflation has really picked up. And we're going to be tracking how the analysts are thinking about revenues for this year and next year relative to our thinking. So there's still room for them to continue to revise their numbers up for revenues this year as they incorporate more inflation into their Excel spreadsheets. And then the same thing goes for next year. Now let's see what we think about profit margins. And here is probably where I get a little controversial. Okay, on the controversy area here, the profit margin is 13.4%, all-time record high. So that's what it was last year. The question is, where does it go from here? And you would think that with all the cost pressures, it'd be kind of foolish to conclude that the profit margin is going to stay this at a record high. Is it going to be squeezed? Well, silly me. Joe and I are projecting that it's going to be flat at 13.4%, that it's going to remain at a record high. And the thinking is that certainly anecdotally and empirically, it looks like all these cost increases are getting passed through into higher prices. And we do think also productivity is continuing to make a comeback. So we think companies are going to do whatever they can to maintain their profit margins. I think that they really have been doing that for a while. And as you can see, they've been in an upward trend. And so we're looking for 13.4%. So if we're going to be wrong on earnings, too high on earnings, it could be that our revenues estimates are now too high. It could be that our profit margins are too high. But you can fool around with these numbers on your own. You can do this at home, and you can see here's our earnings forecasts. And we're now using 240 and 260. And so you can see that the analysts are heading in that direction. And so that's what we get when we take our revenues and multiply it by our profit margins. The question then is, where does all this go in terms of the valuation multiple and all that? Well, we'll get there in a second. But meanwhile, let's just talk about what the Fed is likely to do here. I seriously doubt the Fed is going to do what Volcker did here, which is raise interest rates or allow interest rates to just, by market forces, rise to whatever level it took to bring inflation down. In other words, whatever level it took to create a credit crunch or caused a recession and then brought inflation down. I kind of doubt that we're going to be looking at real rates anytime soon, either this year or next year. So I think even with the Fed's tightening, we're going to see that real rates remain negative. And as I said before, there's lots of excess liquidity in the system. Here's M2 relative to its trend is about $3 trillion higher. Another relevant issue here with regards to recession and valuation. Obviously, if there really is a recession coming, we have to worry about not just valuation, but earnings. And there is something to be concerned about here. And we're seeing that consumer personal income in real terms has kind of flattened out. It's actually down a little bit. Some of that is because we're comparing it. We're not getting the subsidies. So this is the total. The number without the subsidies, this is the nominal number, all-time record high. Doesn't look quite as good when you adjust it for inflation. And the same thing goes for consumer spending. You can see that consumer spending looks pretty good in current dollars, but once you adjust it for inflation, there's maybe we're back to that kind of gradual uptrend if we're lucky. So that is a concern. And then another concern is consumer confidence. It's consumers is really drives the economy. So you don't want the consumer to stop spending. And so confidence is down, as you can see, the overall confidence number. Current conditions are down, but still well above where they were at the lockdowns. But this is somewhat concerning. The expectations have taken a dive here, and the expectations, this is consumer optimism, okay, which is the sum of sentiment. It's the average of sentiment and the consumer confidence index. So it's the two monthly indexes averaged together. And you can see that the expectations component has taken a big dive here. And that is actually one of the 10 components of the index of leading economic indicators. So it is of concern. And it does tie in with the 10 two-year spread, but the 10 two-year spread is not one of the components of the index of leading economic indicators. It's actually the 10-year minus the Fed funds rate, which continues to widen. It's currently 250 basis points roughly. Meanwhile, the consumer looks pretty good on the labor side. An indicator that's included in leading indicators is initial unemployment claims, and they're basically at near historic lows. So the labor market is super tight. We're seeing finally record levels of household employment, full-time employment. So companies are increasingly giving people the opportunity to work full-time. They don't have to work just part-time. So that's a good development. Our earned income proxy, all-time record high in March. This is a proxy for wages, and even adjusted for inflation, it's in an upward track through February. We'll see what March looks like when we get the inflation numbers, but it's going to continue to be in an uptrend. So wages are actually looking not too shabby, and that should keep consumers spending growing. So let's tie that all into valuation, because we did the earnings side of the equation. Now we need to do the valuation side of the equation. And clearly the mega cap 8 have had a huge impact on the valuations of the S&P growth. They account for 50% of S&P 500 growth in market cap terms. They account for 50% of the market cap of the S&P 500. And value, of course, is off on its own. And you can see that a lot of the volatility has been related to the valuation multiple for the mega cap. But you take out the mega cap and you're looking basically at a 17 multiple for the S&P 500. I don't view that as extremely overvalued, even relative to rising interest rates and higher inflation. But I think it kind of makes sense under the circumstances to say that with inflation going up, with the Fed clearly being forced to be more hawkish, let's talk about 16 to 19 as sort of the range for the multiple. So I've kind of given up on the idea that we're going to hold up at this 20 level. And of course, just as I did that, we bounced from 18 to 20. But I think we're kind of looking at this 19 to 16 kind of range. And we're really looking at this S&P 500 red line here. Finally, forward PE, again, let's look at the S&P 500, all in all is 19.3. Take out the mega cap and you get 17, as I just said. So with that, let's open it up to a couple of questions here. Sorry, I spoke for so long, but it's a complicated subject. Okay, let's see. Jessica, what informs your projection of the timing of inflation peaking this summer and falling to 4 to 5%, 3 to 4% next year? Is it supply chain issues resolving, Fed funds rate increases working through the financial system, something else? Well, look, it's this is not science, it's art. And as artists, what we're seeing, Joe and I are seeing, and Debbie and Melissa, the whole team, what we're thinking is that the Ukrainian war has clearly created more supply chain issues, created more inflationary problems in energy and agriculture, and that those things do get passed on into broader measures of inflation. And we're thinking that'll continue to be a source of pushing inflation higher into that higher range that I showed you, into the middle of this year, maybe into the summer. And then after that, yeah, supply chain issues start to improve and demand slows. I mean, demand's already slowing. And as a result of that, companies can start to rebuild some inventories. And a lot of that has to do with consumer durables. The one issue, of course, is in durables is automobiles. We know that there's still issues with the semiconductors, but hey, Elon Musk managed to put out a lot of cars and solve that problem. And we think by the second half of the year, production should be cranking up, and that should help to relieve some of the pressure in the auto market. But it's also furniture, it's appliances, it's those kind of items, and those items tend to fall in price. They don't go up double digits the way they have over the past year. So that's a big part of the story. And if you don't agree with that, you don't think that's going to happen, then inflation is going to be higher for longer than we're thinking. And then as that moderation occurs, we're thinking rent inflation has got nowhere to go but higher over the next 2 years. Okay, David, when you talk about M2, what does that really mean? Can you explain the M meaning a bit more? There's a publication on the website. You send me an email, I'll give you the link to it, showing monetary aggregates, and M2's kind of described in there. But it's basically currency and deposits, demand deposits and savings deposits and so on. So there's also money market funds in there. So that's what I mean. And M2 is what people typically look at when they look at velocity. They'll divide nominal GDP by M2. I like to look at it the other way around, which is M2 divided by nominal GDP. And what that shows me is something like a 90% ratio. In other words, we have almost a year's worth of M2 relative to nominal GDP. And before the pandemic, it was 70%. So there's an enormous amount of liquidity still in the system. Mike, would it be fair to summarize your thinking about inflation, that inflation is controllable from here without a recession and or positive real yields? Well, I don't know that monetary policy just by raising interest rates can do very much about inflation. I mean, it could contribute to slowing demand. I mean, that's Powell's thinking, is that we'll slow demand down. We'll let that kind of equilibrate with supply. That'll take inflationary pressure off, and we'll get a soft landing. At this point, I find myself agreeing that the most likely scenario is a soft landing, because I don't think the Fed is going to do a Volcker 2.0. I don't think that they got the stomach for it, and I just don't think that's the makeup of this particular Fed. If they do a 2.0, then we're talking about a recession. And by the way, I'll be writing about more about a recession for tomorrow. I'm doing that now. And if you ask me what the risks of a recession were before the pandemic, I was before the war, I should say, I would have said 15%. Now I would say more like 30%. So we're clearly thinking about it and have concerns about consumer confidence. But the wages are going up, and that's really what tends to drive consumer spending. Let's see. Okay, Jay, what are the historical PE values of S&P, PE values of the S&P 500, excluding so you probably asked the question before I showed you the chart. So take a look at the chart, Celeste chart in the collection there in the morning briefing. So that should answer your question. What mechanism could lead to recession in 2023? Good question. Historically, it's credit crunches that cause recessions. There were some oil spikes that coincided with that, but I think it was credit crunches that have the longest track record for having set the stage for a recession. So I think that will probably be the case again this time around. I just don't. The reason so in other words, the yield curve really doesn't predict recessions; it predicts credit crunches that cause recessions. The reason I like to think about it that way is then I look around and say, do I see a credit crunch out there? And at this point, I don't. I see a lot of liquidity still in the system. So from that point, I don't see it. Now it's conceivable. Oh, there's Chloe. See, I'm going to have to reschedule the webinar to accommodate her schedule for going out. But anyways, we're almost done, so everything's good. But I don't see a credit crunch out there. I guess it could be that inflation just weighs on real incomes to such an extent. In other words, we have a wage price spiral, but prices spiral up faster than wages. Maybe rents really become an issue, and that really depresses consumer spending. So that I think we still get growth, or maybe we get no growth. It still will be stagflationary. I don't know that we get an outright recession. Maybe we get a growth recession, but it's something I'm certainly watching out for. Debbie and I are watching out for. We'll take Peter's question last year. Any thoughts on oil prices, especially with Biden's decision to release oil reserves? Oh, Biden. I don't know, $1 million barrels a day isn't going to make much difference to the price of oil before we kind of cut into the reserves too much. I mean, I don't know. I'm all for drilling, baby, drill. There's plenty of oil in this country. There's plenty of gas. I think the transition to clean has just been way too complicated and too expensive and too unpredictable. So I think it's got to be a slower transition. But I think the price of oil is probably getting pretty close to a peak here, if it hasn't peaked already. Looks like Iranian production is going to be picking up here. Speaking of Biden, and I don't know why we're doing that deal. But I'm not going to go there. I don't have to go there because we've done half an hour, which is what I promise you. We try to keep that too. And Chloe, you can hear Chloe whining that she wants me to stop doing this and pay attention to her. So without further ado, thank you for tuning in.